Monetary policy is the actions a central bank takes to influence a country's money supply and the overall economy. In the United States, the Federal Reserve establishes monetary policy. It tries to make sure the money supply grows neither too quickly, causing excessive inflation, nor too slowly, hampering economic growth. Ideally, inflation is 2 to 3% annually, which keeps prices stable. The Fed also tries to keep unemployment low, around 5%. The Federal Reserve influences the money supply in 3 ways. 1. Buying and selling U.S. Treasuries through open market operations. When the Federal Open Market Committee buys Treasuries from securities dealers in the market, it increases the money supply and thus lowers interest rates. Selling Treasuries to securities dealers takes money out of circulation, decreases the money supply, and raises interest rates. 2. Setting the interest rate that banks with excellent credit ratings pay on overnight loans from a Federal Reserve Bank, called the discount rate. Banks with less stellar reputations borrow at higher rates. The Fed's Board of Governors handles this function. 3. Establishing reserve requirements, or telling banks what percentage of customer deposits they must keep on hand, say 10%, so customers can make withdrawals. Banks lend out or invest most of the other 90% to earn money and deposit any excess funds with their district Federal Reserve Bank so other banks can borrow at the discount rate to maintain reserve requirements. The level of bank reserves affects the short-term interest rate banks pay to borrow and lend money from and to each other overnight to keep their reserves at the required level. Thus, reserve levels affect the interest rates banks charge consumers for things like car loans and mortgages, and it influences inflation.